hike that was, being factored in the November or December policy meet has substantially reduced. So that is adding to the buoyancy in the markets. But at the same time, dollar index continues to hover around, the 80, 106, $107 mark, which could be a pain point for the market. Now, Sudip, I want to touch on the banking pack. Now, Nifty Bank, on Monday's session, it fell below the 44,000 mark. It's the lowest levels in a month. And, we have seen a good bit of recovery in the last couple of sessions. Day before it jumped up about 1%. Today we saw a 0.5% rise. Even the banking pack managed to, reclaim that 44,500 mark. So do you see that the, the kind of run up that we have seen in the last couple of days, is it a pullback or, from here on, do you expect more upside?
I think it's both, definitely a pullback from the levels it touched on Monday. And we definitely see an upside from current levels. I think there are fantastic opportunities in the BFSI space and particularly large cap banks where I think, long-term investor who plans to build up his portfolio definitely should look at. And I think I mentioned earlier also that HDFC Bank definitely provides a great value buying opportunity. State Bank of India, the PSU packs definitely offers a value buying opportunity. So I think, it is a good opportunity. And leave aside the market prices, look at the fundamentals of the banks. I think the asset quality is probably the best in the last many years. As far as, the margin expansion is concerned, it's happening. RBI hasn't taken up the interest rates up, and that's helping. CASA mobilization is also happening at a rapid pace. So I think there is a confluence of positive factors which is aiding the BFSI. And of course, I should not forget the fact that credit demand is gradually coming back in a strong way. And this is after a long time. If Indian domestic capex cycle does pick up, it will see further demand for bank credit. Now, that's all good news for banks. And all this put together, I think we should definitely look at banks for long-term investing.
Now, Sudip, keeping it with banks, we have seen good sort of base building exercise going in large heavyweight banks such as HDFC, ICICI Bank, in the last few sessions, whereas PSU banks, the returns have moderated. So would you recommend, perhaps shifting the focus to the larger private sector banks instead of looking at PSU banks?
Yeah, as I said, I think the PSU banks did run up quite a bit. And, as you rightly said, they look a bit tired. And there are other challenges as far as PSU banks are concerned, particularly regarding, the next lever for upward movement, the quality of management, and multiple other, factors. Whereas, if you have a private sector bank, performing private sector bank like an HDFC, available at an attractive valuation, why won't you buy that? It's a proven, bunch of managers with a great track record. Why won't you buy HDFC Bank at current levels? Out of the PSU banks, I mentioned SBI already. I think, again, that's available at a very attractive valuation. And remember, its subsidiaries, all the subsidiaries it has, whether it's the cards, whether it's the general insurance, asset management, life insurance, I think they are performing pretty well. And they also provide great opportunity, which in turn benefits the bank.
And what are you making of the recent run-up that we are seeing in the Realty Pack? Now, Realty Pack has scaled 15 years high. Nifty Realty was up about 4.5% yesterday. Today also in the morning trade, it was up about 1%. A lot of these stocks such as Soba, Prestige, DLF have also seen a fair bit of run-up. Now, the cues coming in from the lot of brokerages is that, the demand expectations, especially heading into the wedding season, is expected to pick up. We are also seeing reports of, demand for luxury homes going up in the last few quarters. So, do you think that most of the positives have already been priced in, or is there more room for another leg up?
Well, I think, our views are a little different here. And we believe that, if it's let's say a 5-year bull run in the realty stock, we are probably on the year 2. So we still have a long way to go. I'll give you one small fact. I think it's being talked about. In Japan, Tokyo, the total amount of commercial real estate available only in Tokyo is more than whatever commercial real estate available in entire India. So, look at the opportunity which India is looking at, even from a commercial real estate point of view. And that has not come back really the way residential real estate has come back, post-COVID or around the time of COVID. So I think we are looking at probably just the beginning of the bull run. Well-managed, real estate companies will do wonders. They have to scale up. They have to, up their act. But if they are able to do that, I think the sky is the limit as far as some of the top real estate companies are concerned. So for a long-term investor, I think Godrej Realty, Oberoi Realty, even DLF can definitely be looked at. Just be a little careful about the balance sheet strength of the real estate company before buying it, and then go ahead and buy it for long term.
All right. While we are at it, let's also quickly take a look at some of the stocks that we are tracking, Suyash.
Yes, Shweta. So, among the stocks, the focus today will be on the earnings season. It kickstarts today with IT, the IT pack coming out with its Q2 results. First to come out with the results will obviously be TCS. We'll see the results come out in the post-market hours. Now, the expectation is that the results will be muted like they were in Q1. And, the TCS has also seen an internal management rejig that, was the first rejig that played out since Mr. Kirtivasan took over in June 1. So, as far as costs are concerned, industry like the brokerages and analysts will also be keeping an eye out for that. Now let's talk about the street's expectations as far as TCS's results are concerned. Now revenue on in rupee terms is expected to grow by about 1.3% to 60,160 crore in Q2 FY24, so a 1.3% Q on Q jump, whereas net profit is expected to remain subdued at an increase by just 0.8% quarter on quarter to about 11,162 crores this quarter from 11,074 crores in the previous quarter. Now one of the reasons why we are seeing that the profitability of TCS on a quarter-on-quarter basis will come down is because the realizations have become late. All the deals that the company has landed in the past are multi-year deals. So the revenue outlook is for a period of 5 to 7 years. Now, of course, apart from the numbers, the street will also be closely looking at the management commentary coming from TCS. The focus will, of course, be on the demand outlook and, recovery that is expected in the second half of financial year FY24. Also, analysts will be keeping a close track on, what management has to say about this higher rate for longer narrative that is playing out in the US, which could be a dampener for IT companies as it could, hit the discretionary spend and demands for these companies. Now, let's look at some of the deals that TCS wants. Now, there was a lot of concerns about, in Q1 that as far as the demand is concerned, but TCS has landed a few mega deals, in the past quarter. Mega deals are those deals which are above 500 million. And if you look at the deals that you can see on the screen, $3.6 billion worth of deals TCS has landed in the past quarter. The TCV, the total contract value of the company, is expected to jump 20% quarter on quarter and come in at around 12 billion, whereas it stood at about 10.2 billion in the previous quarter. Apart from that, of course, the street will also be monitoring, what the guidance is. Now, last time TCS obviously exceeded the street's expectation of a $7 to $9 billion, guidance. It exceeded that as TCV stood at about 10 billion. So, guidance also will be one of the important cues that, we'll be tracking through the day. Apart from that, as far as the business is concerned, a few key monitorables will be the performance of the BFSI segment and the telecom segment, which alone contributes to about 52% of the entire revenue of TCS. Also, North America's performance will be tracked, as North America is a major market for the company.
Okay. And while we are at it, let's also quickly get in Sudip. Sudip, what exactly will markets be factoring in as far as the guidance coming in from TCS later this afternoon is concerned? What are going to be some of the key attributes in the guidance that you're going to track?
Well, of course, the outlook for the second half of the current fiscal, as well as FY25, we will be very carefully listening to the management's, views and, opinion on that. We will also have to very carefully watch and try and, understand whether the new deal wins. I mean, they have won deals. I mean, JLR, then there is Nest, then there is Phoenix Group over the last few quarters. But the question is, these large deals, are they going to be margin dilutive? So the margin guidance and their discussions on these, the margin going forward will be extremely important for us to understand. Of course, the announcement regarding the buyback, specifics of the buyback will be watched carefully. So I think by and large, these are the things, results pretty much will be subdued. That is pretty much understandable. Constant currency growth of about 1% is what is expected. But most important is the guidance as far as revenue and margins.
All right, Sudip, thank you for that. But also, let's quickly take a look at other stocks that you're tracking, BOB being one of them, Bank of Baroda in news since
Bank
yesterday.
of Baroda has come under pressure today. The news came out in the aftermarket hours that RBI has, asked the bank to stop onboarding new customers on its mobile application, given that there is some supervisionary concerns. Now the bank has since come out and said that it is taking corrective measures to, work on the things that the RBI has pointed out, and it will not, as far as the customers that are already onboarded, their user experience will not take a hit. And I mean, we are seeing some sort of a correction in the BOB stock. It is down about 2.5%. Even on a month to date basis, the stock has seen a fair bit of correction, and it is one of those stocks, along with SBI, that did not participate in the PSU bank run-up. So overall the stock looks currently weak, and perhaps there could be more correction in the offing as and how this situation evolves. Another stock was MCX. Now MCX has finally come out with the date of the launch of its commodity derivatives platform. The launch will be on October 16th. And if you remember, last week, or later in the September, SEBI had put the launch on hold. It was earlier scheduled to launch on October 3rd. SEBI said that there are some technical issues, and to take cognizance of it, it had put the launch on hold.
But now there's a go.
But now there's a not only a clarity, but we also have a date. As a result, we are seeing a good run up in the stock, and the stock has done fairly well in the past 6 months or so.
And how about Titan stock? Any news triggers there?
So I think there is a buzz. It's not, although it's not confirmed, that Titan is looking to raise funds. What mechanism it will use is not clear much, but we are seeing a good, a flattish momentum in the stock. Titan has been one of the stocks that has performed fairly well. Even the Q2 updates that came from Titan were fairly well. So overall, the stock looks, on a path to positive trajectory.
All right, Sudip, thank you very much, sir, for taking time out. Thank you for joining us here on News 9. And moving on to a story that we're tracking by the way of active build-up of a war-like situation currently unfolding in West Asia, with hundreds of people dead, more than 900 people dead in Israel, and over 700 Palestinians dead. The situation is only escalating. What sort of impact will it have on Israeli markets? To talk about that, my colleague Karthik Malhotra joining us here in the studio. As far as the equities market, the markets, broader markets in Israel is concerned, there is no immediate impact. At least from what we are looking at, TA35, the stock exchange, is up 1.2%.
1.2% this morning. In fact, on Monday we had seen the stock markets in Israel had tanked about 6%, recovered 0.5% on Tuesday, down again about 1.2% or so today. So overall, I think the markets have taken it well on their chin, and not much really to worry about when it comes to specific stock markets of Israel. But I think what is of concern definitely is the import-export trade with Israel and the rest of the world. In addition to that, we are looking at the Israeli currency, shekel, being devalued. It has lost about 11% this year already. And the open market operations that the central bank in Israel is doing by selling about $30 billion worth of forex to keep the currency under check. if we can just pull up those pie charts and take a look at what really is likely to get impacted with this ongoing conflict.
So
Remember,
before I let you go, on to explaining what the economy and how the economy is doing, what is the economic mix of Israel for an average viewer?
So I think, Shweta, it's fair to assume that Israel is a fairly large mixed economy. Its main trade happens to be diamonds, happens to be ammunitions, weaponry, technology circuitry around technology. Agriculture plays a small part in the overall mix, just about 2.5% or so. It's not really an agrarian society, but it's high on tech, it's high on precision tech. It's high on, again, tech with respect to cutting and polishing of diamonds becomes a major, mix within the economy. Trade of oil, petroleum products, import of cars, all these are very, very crucial, vital elements when it comes to the economy of Israel keeping afloat. Now, even if you look at the population mix, you've got about 60% of the population under the age of 15. And the next bulk of that, about 25%, 28% of the population is in the age group between 35 to 55. So you've actually got young children and you've got their parents occupying the size of the population. The core working population between 20 to 35 is limited, and the senior citizens 60 and above, in fact 75 and above, are just about 5% or so of the population. Now, so we've got it here on our screens, and maybe we could just walk across and take our viewers through what this mix really looks like. Now, what is at stake in this ongoing war right now? Let's look at the exports and let's look at the imports when it comes to Israel. What does Israel import? Israel imports diamonds, imports cars, imports broadcast equipment, integrated circuits, and refined petroleum. The numbers that you're seeing here, 6.73, 5.1, 2.5 are billion dollars worth. So overall, the pie is adding up to about $15 billion worth of imports that Israel does. Compare this to the countries where these imports are really coming from. These imports are coming from China. These imports are coming from the US. These imports are coming from Turkey. These imports are coming from Germany and are coming from Switzerland. So these are the countries which are directly likely to get impacted. China, US, Turkey, Germany and Switzerland, in case this conflict continues, and it seems like it's not going to end anytime soon. So China, US, Turkey, Germany, Switzerland will get maximum restrictions when it comes to imports, and a direct impact on the Israel economy is going to show signs of distress even in these five economies. Sector specifically impacted, diamonds being a sector which also impacts India, because India exports diamonds, not in as much measure as China does, but India exports diamonds to Israel. Let's move on to the next graphic and just look at, what are the other areas which are likely to get impacted. Now, let's look at the exports. Now, contrast this with China being the biggest exporter to Israel. Israel's maximum exports go to US, followed by China, followed by UK. India is a sizable export market for Israel. So 5% of Israel's total production is exported out to India. And overall, this entire mix is about 47% or so to the rest of the world. Now, if the conflict continues, which again is likely, then the currency of Israel is going to be further under attack. So the currency has already, like I told you, lost about 11% this year and is continuing to lose steam. Now, as a result of that, the Central Bank of Israel is undertaking open market operations through which $30 billion worth of forex is being sold to keep the economy and to keep the currency, in some sort of a measure of check, so it doesn't get devalued anything beyond what we've already seen.
All right. So from what we look like, India is going to be directly impacted as far as exports is concerned. How about imports? Because we have an import surplus.
Absolutely. So our surplus, our trade surplus with Israel is about $6 billion, which means India exports more to Israel than Israel exports to India, or India imports from Israel.
Right.
So, but 6% overall in the larger scheme of a $266 billion trade deficit that we have, current account deficit that we have, is actually just a drop in the ocean, or maybe, at best a bucket in the ocean, nothing more than that. But I think the larger impact is going to happen to China, to US, to Switzerland, to Turkey, to Germany, which are the larger trade, business partners of Israel.
All right. So if manufacturing and demand in Israel takes a beating, there is no likely direct impact on India as such.
So,
apart from exports,
obviously the indirect petroleum impact is going to directly impact the Indian economy, because that is a conflict which is happening in the whole region, not restricted to one single city of Israel, one single country of Israel alone. So if you have Iran, if you have Saudi participation escalating further into the war, then obviously oil is going to be under pressure. And that's going to have an impact on global inflation, global economy, where India may not be insulated.
All right, and since we're talking about global inflation, global economies, let's talk about the two major emerging economies, India and China. IMF there sort of rejigging its mathematics on who's going to grow how much in the year to come.
Absolutely. So good news coming for India again. I think, we've seen this sort of change in stance both by World Bank and IMF, as well as all other multilateral banks for that matter, where I think the sentiment on India is definitely moving from neutral to overweight. And it seems that multilateral banks are now definitely bullish on India. And this bullishness is reflecting in the numbers, where IMF has actually increased India's growth forecast for FY24 by 20 basis points from 6.1% estimated earlier to 6.3% now. India is likely to be continue to be one of the fastest growing large economies in the world. And this comes again on the back of China slowing down and the entire euro area slowing down. So while IMF is bullish on India, it seems that it is now becoming a little bearish on China, where there is no sign of recovery, no sign of growth on China as well as the rest of the euro area. However, I think US economy has continued to be strong. Despite tremendous inflation, cycle after cycle of rate hikes, we've seen that there has been not too much of a consumption slowdown in the US. In fact, incidentally, even in India, this revised 20 basis points increase comes on the back of robust consumption, which has happened between April and July, the first 4 months of this financial year. That has been factored in by IMF to increase India's growth projection from 6.1% to 6.3%. However, I think, a tad of skepticism here that RBI's projection for growth is 6.5%. So IMF has still not, reconciled or synchronized its growth projection with RBI. RBI has also revised its growth projection or maintained its growth projection at 6.5, looking at the same set of data between April and July. So I think the data set is the same. The consumption happening in India is the same. The volume of trade is reported equally between Indian agencies and global agencies. This is Indian data. This is not Chinese data.
So what does RBI know that IMF does not know?
Right. So I think there could be a further, impact of shocks from around the world, which RBI has been a little more, relenting towards, which IMF may have been a little more hawkish on, seems to be the projection. But again, I think, every time we discuss economy, every time we discuss numbers, we come back to the point that 6.3 ain't good enough.
It's not good to cut it.
6.5 ain't good enough. If you want to be at par with China by the turn of the decade, or if you want to be, a $5 trillion economy by the turn of the decade, we are looking at an 8% growth. And every year that we miss that target, we have the multiplier only increases. So we've got to grow even faster than 8% to make up for the lost, time in reduced numbers.
All right. So while it's a reason for rejoice that IMF has upgraded India's growth forecast by 20 basis points, we're still not there as far as our own targets for 2025.
And these are targets we set for ourselves. Nobody has put a gun on our heads and said that, you've got to grow, you've got to be the fastest growing economy, you've got to be 5 trillion, you've got to beat China. I mean, these are aspirations. This is a vision that we have set out for ourselves as policy makers, as well as citizens who have voted in those policy makers. So, it's a combined vision, and if that vision is not being fulfilled by 1.7 basis points or 1.7% or 1.5%, whichever number we grow at, then the year later, the catch-up becomes that much more difficult.
Absolutely. And since we're on macroeconomic indicators, one of the indicators is that of how much people are paying by the way of taxes. The net direct tax collection is up 18% year on year. Actually, in the first half of...
Yeah, so if you look at the first half, the numbers that I was reading, Shweta, we are up almost about 22%. And in
but
this,
that would be gross.
Across. So, direct tax, 22%. But this comes again on the back of individual direct income tax collections growing 33%, whereas corporate tax, advanced taxes growing about 11 to 12%. So overall averaging out to about 22% is a number that I had read. And of course, this comes, I think, primarily on account of stricter compliance. It comes primarily on account of individuals and organizations seeing how the GST network has become so active, how the Enforcement Directorate has become so active, and how income tax authorities have become so vigilant that anytime you try to evade tax, a notice is slapped on you. And every time you are unable to service that notice, the penalties are slapped on you. So with this whole digitization process, which started in 2010, 2011, we've seen the rate of compliance only increase year on year. I think this data also reaffirms the fact that there are more number of people being added to the working population. EPFO data that we've seen adding over 5 crore people in the last 4 years. Many of them would be taxpayers. A large chunk may be under the tax net bracket, but many of them would be taxpayers. And overall, we've seen this whole process of compliance has improved, and even the cycle of refund has been shortened drastically. So of this 9.5 lakh crore rupees that we've collected in the first 6 months, this is net after the refunds of about 1.5 lakh crores which have been paid back to advanced taxpayers. So out of the gross 11 lakh crores which have been collected, 1.5 lakh crores have already been returned to taxpayers as well.
Right.
And the CBDT is suggesting that up to 5,000 rupees of tax refunds, no questions asked, you're going to get it immediately. Anything beyond 5,000 rupees eligible for any taxpayer will perhaps take a little longer because you'll want to do your checks and balances.
All right. And as far as, corporate tax and net personal income tax is concerned, I mean, look at the disparity, almost 10% to 15%. What are you making of that number? Does that stand out for you? More corporates paying less tax, or more corporates paying tax but not as much as
you're right,
what
Shweta,
was anticipated?
I think, India is at a level right now, and that's a great story that our colleague Amit Ranjan had done, and maybe our viewers should look it up at on our app News 9+. But I think what we are seeing is that corporate tax and income tax, personal individual income tax, right now are contributing equally to India's overall revenue basket, which is at about 15% each, which means all large and small and medium companies pay as much tax in absolute numbers to Government of India as all individuals working in those companies or working in the government sector or working elsewhere. So, and the corporate tax rate is lower at about 25%. Versus the highest slab of income tax at about 37%, including the super rich tax. So this dichotomy exists, but I think the argument in favor of that dichotomy is that if you don't incentivize corporates to earn more, how are they going to employ more people? And hence it makes sense to tax them lesser in absolute percentage terms than individuals, and individuals being a much larger number than the number of companies that pay taxes. This difference does not technically stand out for me. What I'm happy about is that compliance is greater for individuals at about 33% as compared to corporates, which in any case had become compliant over the course
so
of
there
time.
is increased compliance
on account of individuals.
All right. And moving on from that, since compliance is the word, Competition Commission of India says many corporates, big corporates, including Apple and Google, may not be complying with competitive rules. They are under investigation. That's
right. In fact, two distinct cases, both on which the CCI is now weighing in. And in fact, the Google case has also been in NCLAT for a while now. And there has been a penalty imposed on Google in the past for which about 1,300 crore rupees has been paid already. But now we are looking at another scenario. In fact, two different scenarios. What is happening on account of Google is that Google is being charged with being a dominant influencer when it comes to news content. And news content is where, people like us tend to also get impacted and suffer, that Google pretty much controls the algorithm which decides who gets to watch or who gets to read what you and I put out there on our news platforms of News 9. And it's not just News 9, it's the entire industry out there which is saying that Google's dominance needs to be challenged, that Google alone cannot decide whether our articles and our content should be shown to end viewers or not. And the rate at which Google changes its core algorithm, its overall SEO guidelines, its best practices is almost impossible for any news publisher to comply with on a daily basis. So that is as far as Google's case is concerned, which says that CCI is saying that, a dominant influence may be, uncalled for at some level being exercised by Google when it comes to news content. Apple is facing a very different problem. Apple's problem with CCI, as has been with the rest of the world, is anti-competitive practices on its App Store. So on its App Store, in-app purchases going only through Apple Pay. Apple charging a commission of upwards of 12%, 13% on an average, sometimes going as high as 25% or so, and restricting its users to be able to use any other competing apps similar to the ones that Apple offers itself. So it's an App Store challenge which Apple is fighting or is likely to fight CCI on, whereas it is a dominance of news content discovery that Google is fighting. But both have been conflicting with each other, with courts across the world, with the European Trade Commission, with lawsuits in US, and India being no exception.
All right. So when we say anti-competitive, for the benefit of our viewers, what does that really mean? What does it mean?
You don't allow free
Google
and fair competition to exist.
Right.
You don't allow...
So you don't allow smaller players to get the same sort of market or exposure to market that you have.
Versus a bigger player, I think it's
but they are bigger players.
What are you gaining from whom at the end of the day? So who is serving your purpose better? It may be through advertising, it may be directly through revenue that you're paying Google or its affiliate platforms, including YouTube. Or it could also be a function of what Google thinks should be the narrative, what Google thinks should be the content that should be spewed out to citizens of India and the rest of the world. So, and what Google believes as an organization.
So abusing its dominance.
Abusing its dominance.
All right. Those, of course, are charges that both Google and Apple are facing. Anti-competitive practices, that is the allegation by Competition Commission of India. But shifting focus now to a story that we're tracking by the way of Vivo and Lava smartphones. ED, the Enforcement Directorate, is cracking down on both Lava and Vivo.
That's right.
And in fact, what we know so far, and the latest that is coming out, is that Lava MD has been arrested by Enforcement Directorate.
So I think, Shweta, this story dates back to about 2014, and there has been this case against Vivo, where there have been allegations that Vivo has been siphoning off money from India to China. Now remember, Vivo is owned by a Chinese major called Vivo International, which operates in India as Vivo India. But Vivo India has not paid a single rupee in tax to the government of India between 2014-15 to 2019-20. 5 clear-cut years of zero tax at a time when it has been selling its phones in India. Now, where is this money really going? So the allegation has been that about 1 lakh crore rupees worth of money has been siphoned off from Vivo India all the way to China, evading tax requirements, tax demands of Government of India and tax due to Government of India. This year alone, 62,000 crore rupees of tax has been evaded by Vivo. Now, 4 people have been named in this overall evasion. One, of course, is the MD of Lava International, Hariom Rai. In addition to this, there is a Nitin Garg, a chartered accountant who works for Vivo. There is a Rajan Malik, a statutory auditor of Lava International, and a Chinese national as well, operating in India. It's been suggested that
4 people
have been, have been arrested by ED, but it has been suggested that false identities were used, false addresses were used, and business was done unethically, illegally in India, and tax evasion to a tune of 1 lakh crore rupees.
Right, another Chinese company there facing the brunt of investigation by Enforcement Directorate. But before we close this bulletin, it's an important update there, rather by the way of people who are buying to consume more as festive season kick-starts. There are festive sales on e-commerce platforms everywhere, from Amazon to Flipkart, offering massive discounts, and people are buying in huge numbers. Where exactly is this buying capability coming from? Not metro cities, but rural markets.
Absolutely. So, no, not necessarily rural markets, but non-metro cities and urban areas are adding to the demand, which means that it's the bulk of the sales being grabbed across platforms like Meesho, Flipkart, Amazon is actually not happening from Delhi, Mumbai, Ahmedabad.
Not your traditional metro cities.
Not your traditional, cosmopolitan metro cities where we assume and we believe that the spending power and the aspirational value is much higher. That is something that is being squarely contested this time around with the Flipkart Big Billion Dollar sale as well as the Big Billion Day sale and the Amazon sale. What we are seeing is that there is more demand coming in from non-metro yet urban cities, which include the likes of Lucknow, Jaipur, Surat, Pune, etc. These are the cities which are actually contributing to a bulk of sales when it comes to these e-commerce platforms. I think overall it's great, a great message for the overall India consumption story, that consumption is not restricted to the top 8, top 10, top 12 cities of India. Consumption is happening across the country.
Tier 2, Tier 3
Aspirations
cities as well.
are across the country, and this further gets corroborated even with the auto numbers that we saw released yesterday or day before yesterday, where two-wheeler sales, four-wheeler sales, everything is up again. Three-wheeler sales, which reflects non-urban demand, is up. Two-wheelers, which reflects rural demand, is up. Four-wheelers, a pure play urban India phenomena, is up.
So don't live under the assumption that only people living in metro top 10,
the
top
India
15
story
cities
is
are
not
buying.
an Indian metro story anymore.
Right.
I think it's a larger message.
All right, so that's the larger message as far as e-commerce sales is concerned. The festive sales, which begin right after the Shraddh cycle, and e-commerce players are hoping to mint a lot of money on the back of that. But with that, it's a wrap on this bulletin. Thank you for watching.